Okay, welcome everyone. We'll start lesson 4. Today lesson will go through LO4, learning outcome 4, which is about be able to use techniques to measure performance and assess the financial position of organization. So that will be, and the next lesson will be about assignment discussion. Okay, so today lesson key, the command verb we have explain, apply, and report and assess the performance. And today lesson indicative content will go through the ratios, liquidity ratios, profitability ratios, working capital ratios, efficiency ratios, use of resources, utilization ratios, and calculate the relevant performance indicators for the business profitability. And that's all these we will cover in our discussion. These are the command verb indicative content. Okay, current knowledge about financial ratios for SMEs. What do you think, please? Scale 1 to 10, how much we know? Anyone, please? Okay, can we reflect 1 to 10, please? Okay, let's always we reflect. Okay, next we have 4.1, calculate the performance indicator, assess the monitor financial position, performance efficiency, strategic organization. So financial statements on their own are limited use. We know the financial statement, profit and loss, balance sheet, statement of cash flow, and statement of change in equity. If you are identify the business has made the profit of 1 million, that tell you about the business. So does this suggest to you is the business is successful? It might, but not in the previous year. That made the profit of 50 million. So their closest revival earned profit of 60 million. So it is important use the financial statement, interpret the financial statement, and able to draw the valid conclusion. Either which one is the best, the company to be best to be lend them money, best they have, the liquid position, sound are typically involved. They use the comparison of the previous year forecast and competitors with measure the performance with the competitor. We can look around the company asset. We can look around the company balance sheet, cash flows analysis. So ratio analysis is widely used in sport, comparison. And don't forget that the ratios are calculated using the figures already present in the financial statement. Okay, so user of financial statement. There are the number of user of financial statement. They make decisions according to their requirement, like a like a supplier. If they want to lend money and they have to check the credit score, and they have to look around different ratios than others. So that's we need to look around before we make the final decision either to borrow or not, and they can make their decision based on the financial statement. Okay, then ratio use simple calculation based on the interaction in the set of the data. For example, here change in the cost of sale has a direct link change in the sales activity. The change in the sale activity also affect upon the wages, salaries, receivable, inventories, and the ratios used. These interaction are in the simple concise format, so ratios are limited use on their own. So the following point serve a useful checklist if you need to be analyze the data and comments on it. So first of all, we look around the ratios, all the formulas here. Like if we want to look around the current ratio, which is mean the liquid ratio. Normally the benchmark is 2 to 1, £2 worth of asset and £1 worth of liability. That is current ratio. 2 to 1 is the good. It means £2 worth of asset, £1 worth of liability, current liability. Then the quick ratios, which is most liquid, which is near to the cash, current asset minus inventory. This time we are taking out inventory. Sometime inventory can be outdated, no one buy. Even still we have a stock in our warehouse. Divided by current liability. So this is normally should be 1 to 1. £1 worth of asset, £1 worth of liability. But this is not a hard and fast rule. This is varies industry to industry. Okay, this is the liquidity ratio. And then second is the financial position ratios. So interest cover ratio, profit from operation before and divided by the finance cost. Finance cost mean the interest which we paid on if we borrow money. So it's come in time. It's 3 times, 4 times, 10 times higher. If it's dropped compared to the previous year, which is mean the company is becoming more risky. So our profit not covering the cost which we have. So if it's a 2 or 3 times higher than, so if next year 2 3 times our profit drop, so really we can't meet our obligation to make the payments to our lenders. So second, gearing ratio. Gearing mean if you drive car in a high gear, high risk. Exactly the same here. If you have a high borrowing, non-current liability divided by equity plus non-current liability times by if we can do in times, normally we do in percentage. So you can non-current liability divided by equity plus non-current liability. Other formula is non-current liability, which is mean debt, long-term debt divided by equity, how much debt, how much equity, times by 100, not times, okay, times by 100, it's come in percentage. So if it's normally we'll say 60 to 40 is a good ratio. 60% debt, 40% equity, because equity is expensive than the debt. Because the debt, the when we borrow money, because all the interest on the debt on the borrowing will be considered as a business expense. But if you have a equity financing or you raise money through issuing share, then of course the dividend we paid after the tax, whatever left, so that's a bit, so we can save more money if we have a debt financing. But we need a balance, because if we can't fulfill our requirement not making the payment, we can be a really high risk as well as a company. So we need to be really good balance approach. Then we have a profitability ratios. Under the profitability we can look around the return on capital employed, profit before tax divided by equity plus non-current liability. We can look around how much return we have, return on assets, we can calculate return on equity, gross profit percentage. We often use the formula this, and we often will calculate this ratio. Very important. Profit from operation. So this is the direct cost, and we find the gross profit how many percent, and we can compare last year, this year. And then we have is called investor or the use of resources ratios. Thus we can use the inventory turnover, inventory holding period. So these all the formulas. Yes, trade receivable. So to calculate, and the basis of this we can make the decision as well. Various user can make the decision. So financial main objective of financial statement help user to be make the economic decision, and the ratios also help them to make the economic decision. And ratios we prepare based on the figures which is given in the financial statements. So you will see all the formulas here, all being interpreted. The return on capital employed, what shows profit, what shows what is the profitability, return on capital measure the return ordinary shareholder, their invest return equity is only, and excluding the debt. So you will see each ratio. So liquidity shows the how much liquid, 2 to 1 is normally the benchmark. £2 worth of asset, £1 worth of liability. Often we use these ratios, which is liquidity and the current. Okay, then we also use the ratios about the use of resources and our working capital. Working capital mean the running. So inventory turnover days plus trade receivable days minus in trade payable days. Always good to be we have a shorter receivable days So we receive money from our customer in 30 days and we pay 30 days, not 30%. So we receive in 30 days and we will pay in 60 days. So there is a safety net of 30 days. So if we don't have a cash, or at least 30 days we have a cash our own in the flow. Okay, that's always good to be. We need to be look around. Okay, next we can look around next. So these all the ratios, all the formulas being then the gearing ratio. Okay, what we'll do, I'll show you. We have ratios handouts as well. So that which is available on Moodle. I'll show you, and these we can use. Sorry, just 1 second. I'll show you in a minute. I'll share with you. So ratios. So these handout or any other examples we can embed in our assignment when we'll go through. Okay, in a minute I'll share with you the handout which we can use. Okay, so we're back to. So we calculated here in this activities, which is okay. So I'll share with you, and this is the question we have. Okay, question one task, we've been given two companies. One is called Anika, one is Papika. We've been given their statement, which is the profit and loss and the balance sheet. And we have all the ratios. So, all this information, and the basis of this, we can calculate different ratios, which I have calculated based on this handout. So what we can find all the figures. So first is the gearing ratio and the profitability ratios. First we'll go through. So gross profit divided by sales also known as revenue. So if you divide time by 100, that was Anika was 45% and Papika is 52%. So Anika performance is poor than the Papika. So Papika is better to be invested. And we'll go through operating profit. Anika is 9% and Papika is 11 points. So Papika is better than Anika. We can compare, or we can compare 2 years as well. Then gearing ratio, we can look around. This is only 13% and this is 70. So Papika is a high gearing, high risk. So Papika is a more risky company than compared to Anika. So that's, if you can be at the high risk, normally in business we'll say high return. You will see that there is a 52% return, but Anika is only 45. But the gearing is a ratio is quite high. So it's a high risky company, the Papika. And interest cover ratio, Anika is 11.6 times. Their profit is higher than the interest cost, and but Papika is only 3 points. So Papika is more risky than Anika. Then asset test ratios is we said 1 to 1. So Anika is 1.2. It should be 1 to 1 is because this is the less risky. The asset is £1 and 22 pence, and liability is £1. You will see at the top figures is higher than the denominator figures, which is lower. So we can look around that. And Papika is 0.6, which is mean they have a less asset and more liabilities. So on the basis of this, you can make the decision which one is the best to be invested. Other than that, I included the two companies' statements, which is Next and Marks and Spencer, and based on these formulas, we can use actual companies, the statement, which is of course there was the example, and this is Next and Marks and Spencer. Or simply you type Google search ratio and ratios for next, and you can find itself, already calculated one, and you can interpret and you can use for your assignment. So 4.2 is develop the key performance indicator specific business performance measurement, monitoring budget, and the target against actual result. So monitoring budget. So what is the budget? What is the actual result? And the difference is called variance. So your budgeted figures, your actual result is a variance. So that's why we call the benchmark. You can look around and what is actually your. So there is a variance can be the cost. We need to be make sure we control the customer satisfaction is a key that can be effective in the long run. So performance always, if you want to measure someone performance equal to time, cost, and quality. Anybody any question? Please you can chat as well if you have any question. Yes or no? Anybody any question?
No.
Okay, thank you. So performance is always, so here we're looking, if you're just looking the performance in times, in cost, maybe you're missing the quality. So in the long run can be impact customer satisfaction, feedback also crucial as well. That can be, these are can be a critical success factor for any organization, which we can look at these, different performance indicators we can use for different companies. Okay, a company performance may be compared its previous period performance, past result may be adjusted and affect the price changes. So that's we need to be look around. So that's why is a crucial under IES2 International Accounting Standard 2, which is about, anyone knows which is about which standard is it? IES2 is about inventory valuation. We can do by three methods: first in, first out, last in, first out, and average. Yes, these three methods can impact our closing inventory figures and the cost of sales. So that's why we should be consistent with the costing policy. If you're using FIFO, you should be consistent, carry on using, because otherwise one year you're using our ABC costing, are you using marginal costing or absorption costing? Whichever method you use, it should be consistent each year, because otherwise your figures not will be for comparative. Qualitative characteristics in other units we learn about the qualities of financial statement. It should be true, it should be fair, it should be prepared on that, and faithful representation, one of them. Faithful representation, it should be comparable. Okay, sorry, I'll try. Okay, I hope so you can hear better now. Uh, yes, this will be available, will be recording, and should be fine, because I think so about the background noise. Hope so will work. I'll try to be a bit slow as well. Okay, so the company performance always we measure in time, cost, and quality. And IS2 is inventory valuation standard. Inventory have three method of evaluation we can use. But if you use the last year FIFO, this year we should use the FIFO, because otherwise our figures not will be properly comparative. So that's why we need to be make sure we consistent with the costing policy according to IS2. Otherwise it's not give us any question. Okay, if any question please you can ask. Okay. Next, we can move to the next slide, which is horizontal analysis. Try to be overcome the problem of vertical analysis. The common compare the performance of particular period of performance equivalent to company for the same period. Introduce an independent yardstick to the comparison. However, very important to pick the similar. If you're comparing the corner shop performance with the Morrison, so that can be totally different. So we should be compared with the same size, same volume in the same industry. We can compare with other industry, but maybe the performance should be different. Industry averages we can use it, and we can compare the type of analysis. Compare the company results ratio to a of the average of many similar types of companies. Yes, such the scheme operate in the subscription basis of, so we can look around, so which you can compare what is the average, like people say in the food industry is very high, high return. So if you compare the other companies, so we need to be make sure FMGs, if you use the word, is fast moving good. So if there is a 1 to 1 instead of 2.1, which is absolutely fine because we quick, Okay. Then when we consider the company strategies, we can based on the ratios, and we can pick, particular the weakness of the company. They don't have a good strategies as the business is plan, to deal with weaknesses, how they can overcome. Yes, maybe we need to engage with various suppliers, and we can borrow the money, and like trade receivable days maybe, and trade payable days. We need a good negotiation skill, inventory turnover days. Yes, that's represent the working capital cycle as we mentioned. Okay, then we have a performance measurement technique. It can be financial, non-financial, balance scorecard, and the benchmark, industry benchmark. What is the key, average of industry? So investor, they help, to determine whether to buy or hold assets, the ability of entity to pay the dividend. Potential investor help to determine whether to buy the shares or bond. Lenders, whether their loans and the interest will be paid when due, and suppliers for the trade creditor to determine whether the amount owing to them will be paid. So different decision can be made on based on the ratios. Okay, so I copied here GSK's performance. GSK is called GlaxoSmithKline, which is pharmaceutical company. We can copy this link. We can measure the result of GlaxoSmithKline. Okay, then next we have 4.3 the result interpret, which we discuss in the company Paprika. Was the better in gross profit, operating profit? Paprika is the better. Anika is less risky company because their gearing ratio was low. Interest cover ratio was high, so that's the less risky. And asset test ratio was the better than in compared to. So compare based on all ratios. So far the profitability is concerned, better ratios found in Paprika. Anika's profitability ratio, which is not good compared to the perfectly, but is the perfectly acceptable with 45% and 52. The other ratios of Anika is better than Paprika. So while the Paprika interest worse, yes. So there is. So in conclusion, we can advise to Lewis in that question was your main concern the riskiness of investment. So I would advise you to invest in ICA, which is less risky. If you're not a person to take the risk, so you can invest in less risky. Like if you want to be invest in oil company, is a less risky because but is a less return and you have to wait. But if you want to be invest in technological company like Apple company, they can go up, they can go down. Is a high risk but high return like a Bitcoin and various others. So we need to be think about Paprika is more risky and less, solvent. So that lead to be further danger. Okay. Then we have a merit criteria. We need to be do analysis, qualitative, quantitative measures. So the main objective of financial statement to make you decision in this assessment, we can calculate and comments on the ratios, and we can suggest, interpretation for and who is the user. Okay, we can look around the consider the strategies, we can make it accordingly, and then next, we can look around the distinction criteria. We have included two companies, their the statements. Based on them, we can calculate their ratios. So based on the formulas, yes. So you calculate the ratios and above calculation ratios of 2 years, and then you decide which one. So we have draw the conclusion here. We have 2 years calculation. The current ratio is a decrease. It suggests the company is the poorly liquid. How the ratio is the acceptable level. So we need to draw our acceptable level, and we can look around and again the industry benchmark. Any question from anyone?
No.
Okay, then the next slide is all about the shows relatively less quick asset to meet the current liability. So based on your objective, and which it can be varies individual to individual and companies to companies, and that's maybe some people say Bitcoin is really good, and some say don't want to be take the risk. Huh? So it's up to them. So we need to be look around what are the objectives which we can achieve, and different user use for different. And other than that, I included a link for you. Please, you can do in your own time, copy the link and do the quiz. Huh? That will help you to be well further understanding. And the books and all the resources already on Moodle. But if you have any question you can't find or locate them, please let me know so I can send you as well. So today we discuss about ratios. There are four types of ratios: major category, profitability, liquidity, use of resources, and financial position ratios. These are four categories, and under each category we can pick two ratios. In our assignment we can analyze, or we can pick already calculated ratio through Google Finance, and those we can use it in our assignment. But we need to interpret, is it good to be invested, is it yes good for investor, or what type, like a liquidity 2 to 1 is a good, but we can compare it against the industry averages, and we can suggest which one is a less risky and which one is a more risky, and that we can make the decision to go ahead with the business with the company or not. If we are lending company, so maybe we looking the financial position, which is a gearing ratios as well, and we can look around the interest cover ratio. Of course, we can look around the profitability ratio. That's we really concern as well. And of course, we also can look around the cash flow statement, the cash position of the company, because you can increase the sale by doing the credit sale, but maybe if you, because the cash is a crucial thing as well, so that's why the company also looks for statement of profit and loss, financial position, balance sheet, but also they look around the cash flow and the cash flows under the operating investing or financing active. So that's all today from my side. Anybody, if you have a question, please you can ask. And otherwise, I'll go through in the next lesson. I'll go through with you our assignment discussion, where we'll go discuss, how we can address all the learning outcome within our assignment brief, within our assignment. So that's all today, guys. Those are listening, please drop me email as well if you have any question. I'll try my best to get back to you as soon as possible. Okay, thank you.
Many thanks.
Thanks.
But
Thanks.
when will be the final assignment discussion?